Hello, welcome everyone. Today we'll discuss chapter 6, which is based on the corporate finance using a book called Foundation of Financial Management, 18 editions. Author is Block, Hurt, and Danielson. It is using with the McGraw-Hill copyrights. So this chapter we're going to discuss about working capital and financing decisions. Okay, let's look at the earning objective first. The first one is to explain working capital management, which involve either financing or controlling of the current asset of the firm. And recall what management, number two, recall what management distinguishes between current asset that can easily be converted into cash and those that are more permanent. Number three, recognize the financing asset of a financing of an asset and should be tied how long the asset will likely to be in the balance sheet, and explain why the long-term financing is usually more expensive as compared to short-term financings. And recall the risk, what is profitable, and determine the financing plan for the current asset. And of course, lastly, we're going to illustrate what is the expected value analysis. Okay, let's look at the chapter opening. What is working capital management? Working capital management is financing and management of the current asset of the firms. Okay, this is the key part. And then current assets will change constantly, requiring decision to made by management. Sometimes you have an overcash, then you need to do cash management. Sometimes you are less liquid, then you need to do something about it to make sure your cash is enough to pay your obligations. And then you have a short-term decisions on working capital and determine what firms can long-term and that requires immediate actions. And then the nature of asset growth. Key to current asset planning is matching production schedule with accurate sales forecasts. The difference between actual sales and forecasted scale can be resulted in unexpected buildup. A reduction in inventory will affect receivable as well as cash flow. The firm current asset can be self-liquidating asset or permanent current asset. These are the firm's current assets. Okay, let's look at the graphic now. The next one, we're gonna have a limited or no growth asset dollars. We have a go up here. This is the fixed asset on the horizontal lines. You're gonna go up and down temporary current assets and then move up. This is typical limited or no growth. And then you have stage 2, which is the growth. Continue on the current asset. We have base here, fixed asset. This is a time period, and your horizontal and then vertical is a dollar sign. So you're gonna go up and down, go up and down, go. And typical current asset will go up and down depending on your growth stage. Okay. Fixed asset can grow slowly. Why? It is going to increase your production capacity, replacement of old equipment. This is what has happened in the automotive industry. There's a tendency to build into automated product or robotic process. So they're going to increase the productivity in terms of capacity. And then current asset also fluctuate in the short run depending on the level of production versus the level of sales. When production is higher than sales, inventory will be rising. When the sales are higher than the production, inventory will decline and receivable will increase. Okay, look at the cash budgeting process as well. You have the level of production method into smooth production scheduling, as well as use the manpower and equipment to lower the cost. Make sure that Toyota is one of those good example. They have a good production schedule and in terms of use of manpower as well as equipment. And then you also need to match sales and production as closely as possible in the short run. Allow the current asset to increase or decrease with the level of sales, and limiting this large seasonal bulge or sharp reduction in current asset. This is a good example of sales and production. More the Japanese firm and Korean firm, mostly they are using a just-in-time system whereby the order sales coming in and the customer has to order it and then they start producing it. So they are able to eliminate the cost of inventory carrying the inventory cost, as well as to being able to use efficiently the current asset. Okay, let's look at another example. Harley Davidson is an example of seasonal sales during the month of summer or spring. In Canada, we have 12 months of period in which only 4 months can be used for riding season. That is called the summertime. For the last 8 months, going to be too cold to ride. Okay. Farm revenue peak in the quarter ended June 30th, so during spring and summer we're going to go up, and then sales bottom up in the last semester, especially during winter time, and then June profit will always higher quarter, while the December profit are always the lowest. A good example in the COVID pandemic, discovered normal sales and profit in time. There's 2 years COVID issue for the last 2 years, and there's a lot of disturbance in terms of production lines. People have to wait 2 to 3 years in terms of getting a new car. It's a good example because of chip shortage in Taiwan. Okay, so that's a good example of disruptive normal sales. Look at the example of here, the quarterly sales and earning per shares of Harley Davidson. It goes up and down, depends on the seasonal sign. The same thing with the earning per shares. It goes up and down, according to the seasonal sign. The major competitor for Harley will be Indians motorcycle. Controlling asset, matching sales revenue, we're going to continue. Retail firm like Target and Macy's also have the same seasonal sales pattern. During product they are managed for them, involve matching sales inventory, selling affected by weather, holidays, therefore you can avoid interest. So most of the sales, Target and Macy's, happen during the holiday, Christmas season. People are start buying gifts for their families, and Target and Macy's have the high seasonal sales usually during the December month. Okay, let's look at the fourth quarter. November is their biggest quarter of the month and more than half of the sales. So look at this fourth quarter, January to January is their biggest quarter of the month to more than half of the sales. This is a typical Target Mercy on a retail shares. Okay, so look at the Target Mercy. Target is the blue line here going up and up. So remember December. Here, remember the month here, November to January, right? So we go back here again. The graph for Target. All the way in terms of millions. Earning per share also fluctuate according to the sales in millions. Okay, that's the key part. So you can compare between Target and Mercy. Remember, you have to compare orange to orange. You have to compare apple to apple. That's the key. And then retail-oriented firm use new and competitive inventory system, PPR system, to link the online point of sales inventory. For now, it's called Salesforce. It's the new system that is being very popular in North America. Because they are a point of sales system. Okay, allow either digital input or use of optical scanner to record inventory code, numbers, and amount of each item sold. Managers can examine sales and inventory levels by item and adjust order to production schedule. It is predictable of the market will influence and the speed of managers' response, and in terms of complexity of production will dictate the speed of production so changes. Okay. Another example is Yamaguchi Motorcycle Company, or example, sales fluctuation, high sales demand during early and spring and summer. Okay, sales drop during October to March because of the start of the fall season and the winter time. Decisions will be based on the applied level production method and based on the 12-month sales forecast issued. The result is the level of production and sales combined to product fluctuation inventory. This is a good example of a motorcycle company. So you got the sales here, October, dip, and stop picking up in April to August because of the spring and summer season. Motorcycle is a better example. I'm myself a motorcycle enthusiast and been driving motorcycles since 14 years old. So in Canada, it's one of those unique country whereby you can only driven 4 months in a 12 months. Okay, so this is based on the US side, cycle. Okay, but we will see the same thing with a lot of motorcycle shows started already in January, and it will bear fruit usually either March and April is picking up there. Okay, most of the sales are second-hand motorcycle, as well as the new sales are coming on this month usually. All right, look at this beginning inventory, schedule inventory from October to September. We have the beginning inventory plus productions minus sales equal to inventory. So this is the typical inventory level. You're going to see a peak here in March, dip again, dip again. So the highest will be like a March. This is a typical example of the schedule of inventory, guys. You got the sales here, pick up here usually. Why is there a dip here? There's a pickup sales in starting March all the way to August. Okay, but it's very slow sales in October to December, 0 January, February, because it's so high winter's time. This is the hot time of this is the peak of the winter time. And then look at the logic here, and you're going to go into the detail. You're going to get ending balance. You're going to calculate here. So this is the typical, when you do sales forecast and cash receipt, payment and cash budget, you always use Excel. It's easier to use. So this is your daily cash routine. When I was a financial analyst, I use this almost daily basis. Use Excel, and then you must be able to calculate each category and make sure it can be tied up in terms of forecast. Okay. So what are the build up of account receivable? It is based on sales forecast, cash receipt, cash payment, as well as cash budget. Cash receipt based on 50% represent cash collected during the month of sale and 50% the prior month. Cash payment based on the assumption of level of production, payment and over dividend, interest and expense taxes. Cash budget based on the cash receipt and cash payment. So this is give you an example. First year current asset based on account receivable 50% forecast, okay, and then inventory level is going up at the March level here, up here April all the way to September. So this is from October to September. Okay, we also look at again cash budget asset second year for no growth in sales. There's no growth in sales. Okay, this is no growth in sales. So million minimum balance 0.25. Assume the cash balance 2.5 million at the beginning of October and 0.5 million at the desired minimum cash balance. So you will see this type of balance sheet forecast cash flow all the way up to the minus here, the highest cash flow negative here. Okay, and then all the way to start being positive in April because of the sales of the motorcycle becoming popular, right? All right, look at the terms of the nature of the asset growth is going up, inventory going down, going up, going down. So it depends on the month again based on the cyclical situation of the motorcycle and the weather. Alright, selecting pattern, instructing external sources into finance asset. The most appropriate financing pattern will be matching up asset buildup versus the financing length of the term, using a temporary buildup in the current asset and permanent current asset and fixed assets. Okay, so what are the temporary current assets? We're going to be moving up here. Typical temporary current asset. You have a fixed asset constantly here, and the permanent asset here. Fixed asset will be here, debt and equity. Long-term finance will be depends a combination of permanent current asset plus fixed asset, and you will have a short-term financing. Okay, short-term financing here like working capital loans or promissory note or anything like that, or other protection or something like that. Okay, long-term financing will be like bonds or a 5-year bond, a 10-year bond, a 30-year bond. Yeah. Alright, let's look at the alternative plan. Challenge the construction finance plan that is categorizing current asset into temporary permanent, and predicting the exact timing of an asset liquidation is very difficult. Also difficult to determine of short-term and long-term financing available. Okay, in terms of the adequate capital, you can finance fixed asset, you can finance permanent current asset, you can also part temporary current asset. Okay, you may rely on long-term funds to cover up as part of the short-term needs, and you can adequately. You must have an adequate capital of all time. You have to make sure you will be able to meet your obligations. Okay, and then this is a typical using long-term financing as part of short-term needs. So you are using a long-term financing. Much over to meet the short-term need. This is the best strategy so far. Okay, using long-term financing to be part of the short-term need, to fulfill the short-term need. Why is the best strategy? Because you can lock in your financing costs. Okay, because you want to avoid the fluctuation in interest rate. If it goes up, that's going to be terrible. If you are financing, you're not using long-term financing. Okay, so look at the short-term financing approach, which is the opposite approach. Many small businesses do not have total access to long-term. That is correct. Rely on short-term bank interest rate carried it. Advantage interest rates are lower. Sometimes short-term asset can be used for temporary asset, part of the permanent working capital. But this is the opposite approach. This is good. Most of because of using a short-term finance is no good. When there is a fluctuation of the interest rate, then you're gonna be stuck with higher interest rate. Okay, so you want to make sure if you have a long-term finance is much better. You can lock in your rate. You can do much more stable forecasting in terms of your financing expenses. Okay. Alright, assuming long-term financing part of long-term is the other way around. We're gonna use short-term financing for long-term asset. So this, I live in Asia during the Asia financial crisis. That's where there's a problem. Most companies are using short-term financing for a long-term need. So this is creating a problem. Why? What happens? Because they are borrowing in US dollars. Then there's Asia financial crisis. The currency went bust. Their local currency went bust. Their US dollar 5 times their value. Then the company has to go bankrupt because of that issue. Because you are doing short-term financing to finance long-term needs. Okay. So you don't like to do that because it's. There is much more much more problem with the interest rate fluctuations. Let's move on to the next one. In terms of financing decisions, some questions are flexible while others are locked in few available funding sources. During the economic boom period, shortage or low-cost alternative exists. During the boom period, okay? Firms minimize their financing costs, raise funds in advance of asset needs, and important to select the right time for finance. This is a key part. Many CFO I noticed when we do when I was an investment analyst at Nomura, as well as at Morgan Grenfell, we do a lot of analysis on this. We want to make sure the company are sustainable as going concern in the long term. Okay. In terms of the structural interest rate yield curve, show the relative level of short-term and long-term interest rate. U.S. government securities use a free default risk. Corporate risk move in the same direction as well as U.S. government securities. Yield curve for both securities can change daily, depends on the current quantitative conditions, expected inflation, and changes in the economic conditions. Okay, there's three basic theories describing the shape of yield curve: liquidity premium theory, market segment theory, as well as expectancy hypothesis. What is the liquidity premium theory? It's the long-term rates is be higher than the short-term rates. Incentive hold less liquid and more price-sensitive securities. That is the liquidity premium theory. But market segmentation is that treasury securities are divided into market segments by various financial institutions in the investment market. And then expectation hypothesis is the yield on the long-term securities are a function of short-term rates, and over the time period, long-term securities are outstanding. So this is a typical yield curve in the US, okay, in August here, November here, January here. So flags. Now we're going to look at the next picture, the long and short-term interest rate. Moody's here, all the red and the blue and the green one. Okay, and then look at the comparative working capital financing, Plan A versus Plan B. Both of them using the first one is going to use a 6% here, and then long-term is 10%. You see, you have a lot short-term much higher. Plan A using short-term, Plan B is using more long-term financing. Here is the same thing. So there depends on your decision process which one is suitable most. You have to calculate very carefully. If not, you're can create a big problem in the survival of the company. Okay. All right, earning before tax at what A? Plan A has the same thing. Earning before tax, Plan A generate 120,000. Earning after tax for Plan B, which is 109,000. There is the difference. Okay. Again, interest rate, it depends on fluctuation. You need to be able to at least predict where the interest rate going, so you can lock in. You can decide which strategy, the Plan A or Plan B, in your company. Tight money periods. During tight money period, capital is scarce. Short-term financing may be difficult to find or maybe have high rates. It's inadequate financing, many loss of sales and financial embarrassment. This is the tight money period, okay? Before we are discussing during the boom period. Okay. Now, expected value of the sum expect the current conditions in normal conditions will be about 8,500, and using tight money will be minus 3,000. You see the difference here. So you need to be able to at least forecast for the direction of the economy to make sure you be able to weather the storm. Okay. The key part is for the company, a strategist, a CFO, a CEO is to be able to weather the storm during the this kind of period. Okay. And then in terms of XYZ Corporation, expected return is normal condition is 8,400, tight money again minus 10,000. So this is to give you an idea how it is in terms of the tight money conditions. Okay. The firm should also relate asset liquidity for financing pattern and vice versa. Besides how wishes to combine asset liquidity and financing need, a risk-oriented firm will borrow short-term, maintain level of liquidity. Conservative firm will always establish long-term financing and maintain high degree of liquidity. Again, the key part is cash flow. Okay, guys, high degree required to make sure you are always going concern basis. Okay, in terms of logic here, asset liquidity, financing plan, short term will be high profit, high risk, and then long term will be moderate profit, moderate risk. For high liquidity will be moderate profit, moderate risk. For short term, low profit and low risk. So depends on whatever it is the strategy you will use. You have to choose between the two. Make sure most CEO, CFO depends on the style that you management you get the mandate from. Especially stakeholders, you can always do using good financing plan, either short term or long term. If you want to have a short term, it is high profit, high risk. But if it is you want to long term, it will be low profit, low risk. Most Japanese company that I've been working for so far for the last 10 years in Asia, they are mostly long term. Japanese companies, Asian based company, from Korea to Singapore based, they are mostly low profit, low risk. Okay, but the American firm mostly high profit and high risk there. Okay, all right, guys. Basically, this will conclude that chapter 6. So hopefully we can see again in the next chapter. Bye bye.